So, how are you all? Had a good weekend?
Yeah.
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 Good.
Yeah.
Okay, so this session we are combining both groups. Okay, so I thought this is more generic, so both can benefit from one session. So I don't know if you remember, I'm just showing it on my screen, the slide we discussed about Shiv and Beam. When I was talking about Beam, I mentioned that Beam was investing at low cost index fund at 12% returns. So we never talked about what is this low cost index fund. So this session today we will purely talk about index fund, how one can invest in index fund, what is index fund, um, and the details around it. So just to connect back, we touched this index fund when we were talking about Shiv and Beam and how Beam was investing his savings, college savings, and he made 12% return. So that was a low cost index fund. So let's come back and see what is index fund. So I have few videos. Let's see them first, and then I can do whiteboarding. So
You've likely heard news reporters say things like, the Dow is up 100 points, or the S&P is down 5
yeah, you can hear, right? The audio.
Yeah, we can.
We
Yeah.
can hear it.
points. But what does that mean? The Dow, S&P 500, and NASDAQ are examples of stock market indices. A stock market index measures the performance of a collection of stocks. By measuring these stocks collectively, indices track how the overall market is performing better than only looking at the performance of a single stock. Think of it this way. If you focus too closely on just one thing, you might not have a good understanding of the larger picture. This is why an index's performance provides more complete information than the performance of individual stocks. Indices provide a wider view of the stock market as a whole. The first index was the Dow Jones Industrial Average, published in 1896.
So this was the first index that was calculated by a journalist in 1896. So let's see how he did it.
Financial reporter Charles Dow added up the closing prices of 12 of the largest stocks at the time and divided the total by 12 to get the average. Today, the Dow consists of 30 of the largest and most successful companies in the US. These companies are hand-picked by experts to represent a wide variety of industries. Some of these companies affect the average more than others, though, because many indices are weighted. Think of the idea of weighting like grades. A final exam is going to make up a larger portion of your grade than a daily homework assignment. In the Dow, companies with higher prices are given more weight. In 2018, Boeing, the highest priced stock in the index, made up about 9% of the index, whereas Pfizer, the least expensive stock, was only 1% of the index.
Yeah, this was
So a change in Boeing's price was only 1% of the index. So a change in Boeing, the least expensive stock, was only 1% of the index. So a change in Boeing's price would have had a greater impact on the Dow than if Pfizer's price changed. While the Dow is the oldest and most well-known index, some believe that its measurement is less representative of the overall market than the S&P 500, even though they often perform similarly to each other. The S&P 500 measures the performance of 500 of the largest publicly traded companies in the US. Due to its broader exposure, some believe that the S&P 500 is the best measurement of the US stock market. The S&P 500 is weighted by market cap. Market cap is the number of a company's outstanding shares multiplied by the price per share. Because of this, the companies with the largest total market value have the greatest impact on the average of the S&P 500. The NASDAQ composite, also referred to as the NASDAQ, includes 3,000 or so companies that are traded on the NASDAQ exchange. The NASDAQ includes more smaller companies than the other indices, but also includes many of the largest tech companies like Apple, Amazon, Microsoft, and Alphabet. Because nearly half of the companies are tech companies, The NASDAQ is widely considered a better gauge for the technology industry. Some of these companies may also be included on the Dow, the S&P 500, or both. Each index helps measure how the overall market is doing through the performance of the securities it tracks. Though the market may vary day to day or even year to year, the historical performances of indices show that over time, the stock market tends to rise.
So, any questions? I can probably take the whiteboard and I don't know. Do you remember I was telling you some time ago when we were talking about number of stocks that are being traded in different exchanges? You remember we talked about different exchanges across the world. So, for example, in India there are about 3,500 to 4,000 uh, stocks are traded in. So in India we have Bombay Stock Exchange and the National Stock Exchange. So combined together there are 3,500 to 4,000 companies are traded. Similarly in US you have New York Stock Exchange, NYSE, and then you have uh, um, New York Stock Exchange and there is another stock exchange I forgot. So there are overall there are 3,000 companies are traded in US, 3,000 to 3,500 companies. So similarly in Denmark we have Copenhagen Stock Exchange, and I don't know the exact numbers. I believe it would be 1,000 to 1,500 companies that are traded. So if you remember, so every day companies goes up and down their prices, and in order to understand how the market is performing, this generalist, as you saw in the video, this generalist in 1896, he picked up top 30 companies, and then he looked at the market value of the companies on the day, at the end of the day, and divided by the number of companies. Then he got the industrial average. So basically in indexing, what we are doing is, so there are couple of indexes. Uh, One is Dow Jones, as you saw in the video. It's tracking industrial companies, like um, Boeing is an industrial company, the company that manufactures aeroplanes, and Pfizer is a pharma company. Railroad companies are also listed. So any companies that are from the manufacturing side, they are tracked under Dow Jones Industrial Average. So there are 30 companies in this. And similarly, there is another index called S&P 500. S&P stands for Standard and Poor. It's a rating agency. We will talk about rating agencies. So what S&P 500 does is it tracks the top 500 companies of US. Okay. So basically, if you look at S&P 500, you have top 500 companies of US, and Dow is consists of top 30 companies of top 30 industrial companies of US. These both are US index funds. Similarly, there are index funds in India, Japan, Germany. It's the same idea. So basically, they take the top companies, and then the top companies gives the better measurement of market, how it is performing, and that's how they report every day. If you see in news, any business news, you would see that if you are hearing about US markets, you would see Dow end up 2% up or 10% down, 20% down. So basically it's a easy way of measuring how stock is performing, just picking up top companies and track them how they are performing. So we don't need to track all 3500 companies. So that's the idea of this indexing. They started with this kind of indexing, how they can track the sentiment of the car markets. So then in 1960s, the founder of Vanguard, that's a company, he started index in index investing, indexing investing. So basically, what Vanguard founder did was he realized just in investing index funds give the average better returns comparing to the individuals who are investing in individual stocks. For example, until Vanguard started indexing fund, until 1996 and 1960s, we have something called mutual funds. Do you heard of about mutual funds? So any individual who wants to make money from stock market, so let's say these are individuals, any individual who wants to make money from stock markets or financial markets, so what they used to do is they go and buy mutual funds. The problem with mutual funds, guys, is they charge minimum 2%. So for example, if you invest, let's say 100,000 Danish krone, DKK, with one of the mutual fund, I call MF mutual fund. MF stands for mutual fund. So you invested 100,000 with one of the mutual fund. End of the year, no matter whether that guy, this mutual fund, whether they made money of this fund which you gave him to manage, he would charge you 2%. So what is 2% of 100,000? 2,000. So
2000.
so every year this guy is charging you 2,000 Danish krone for him to manage the money you gave it to him, this 100,000. So that's the money you have to pay him, because he has analysts or many people working for him. For them, then it costs money, so they charge you 2%. So for example, this 100,000, this guy, let's say, made 10% return in a year. Okay, 10% return. But in that 10%, how much is he eating? He's already eating 2%, right? Because you have to pay him fees, 2% fees. So in net, you are making only 8%, because you have to pay him 2% as a fee. So yeah.
It's the same with banks, right? Because in index funds, there's different index funds. Like there's house index funds and then there's bank index funds. And then yesterday I was just discussing with my dad a bit, and then he was saying that, for example, when there's like the interest rate is going down now, so if the money gets lower if you put it in the bank.
Yeah.
He says it's good and it's bad. Because it's bad because then you lose your money, but it's good because then you have to charge less. But if the interest rate is very high, then when you take the money back, then what happens is that you have to charge more.
Yeah, that's correct. But let's say you have 100,000 today. Okay. What are the options you have to invest this 100,000? One is you go and put it in bank in your savings account. That's where I think you are referring. We have negative interest rate. So as of 1st of July 2021, in Denmark, if you put money into bank, they would charge you minus 0.16%. That's the interest rate. So you have to pay banks to keep the money. So that's one option. The second option is you go and invest with a mutual fund. You go to some mutual fund and invest with them. That's the second option. Somebody has to go on mute. It's so much noise. Okay. So that's the second option. Second option is you go and you realized, hey, I don't want to put it in a bank because in bank I would lose money because there are negative interest rates. So the next option you have is you go and invest with one of the mutual funds. There are many mutual funds, but the problem with the mutual fund guy is either he is making money or losing money. He would charge you 2% every year. The next option you have is you go and park your money in index fund. So basically in index fund, your charge is almost zero. There is no charge, and whatever the returns, the indices, we talked about different indices, right? Dow is one indices, Nasdaq is another index fund, S&P 500 is another index fund. So basically you have option, hey, I have 100,000 DKK. If I put it in a bank, I would lose money. If I put it in mutual funds, they are charging me 2%, no matter whether they make money for me uh, or lose money when they invest in individual stocks, they still charge me 2%. Or I go and put it in index fund where I have zero charge, they don't charge me, and I have options. So either I can invest in Dow index fund, Nasdaq, or S&P 500. These are all US options. You have similar options in India. I will share those in coming slides. But so basically, it's always a decision, financial decision a person has to make given options he has at a given point of time. Um, Now we are talking about 2021. Okay, I will just go back to 1996, 1990 to 1996. So we will talk about same scenario. What was the scenario like in 1990 to 96? So you have banks. In banks in India, you used to get 16%, 14 to 16% for saving fixed deposit and savings account. This was 90s. In India, if you park your money 100,000, you would have made 14 to 16%. Let's say in mutual funds, again you have this 2% charge, and then index fund was giving almost 15 to 18%. So which option would you choose if you are, let's say, in 1990s and 1996, and you had 100,000 and you had three options? Which option would you choose? So basically safest is the bank, right? So if I'm parking it in bank and it giving me 14, 15, 16%, This is the option obviously everybody like to choose, because just I can go and index fund is the second best option. Second best option. Mutual funds is the last option. The problem with the mutual funds is there are many of them, and you don't know who would invest it good, and who would invest it really good. Some mutual funds 1 year they perform really good, 3 years terms they perform average. If you look at the 10 years track record of any mutual fund, they will done less than the index fund. So it's proven that 95% people can't make returns as good as index fund in long run, if you consider about 10 years in mutual fund industry. The reason being is it's this charge, 2% charge. So that's the killer in this industry of mutual funds. And the track record is really bad. I mean, for 1 year track record, it may be colorful. You may see mutual funds advertising, oh, in 1 year we made 45%, 60%. But you should ask them what is 10 years record. They would have failed in the 10 years record. They would have not made even how much one could make from the index fund. The advantage versus mutual fund and index fund is that here you have almost a zero expense ratio. Expense ratio is a term you need to remember. Expense ratio is something, how much are the given instrument, I would call, we can call this are different options or instrument, how much given instrument cost me to manage that. So in index fund it's almost zero cost. Mutual fund expense ratio is 2%, so you have to pay them 2% in order to invest your 100,000 crore. The uh, the banks, you don't need to pay, because banks is paying you in return. The another option is, fourth option is picking up mm, or investing your own stocks. You do the research and individual stocks. So one can also do individual stocks. So if you are good analyzing businesses, if you are passionate about reading annual reports, or you are passionate about businesses, and you like this way of investigation and identifying great companies, then you go and do your individual stocks. You probably pick Google, you know Google, Apple, whatever the companies you want to invest. So you could pick individual companies and invest yourself by opening a brokerage account. Their expense ratio is zero, right? It's your own money. You are investing your own money. You don't need to pay anybody. So these are all the typical options one has at any given time in their financial life, at any given month, whenever they get a money from the work, whatever they are doing, either job or working for their own business or investor, whatever the money they would save after all the expenses, they would always have these options of either put it in a bank, or put it in mutual funds, or put it in index fund, or put it individual stocks. There is other option you could that's the one which we saw Beam also did, real estate, right? So that's the fifth option, real estate. So these are the different options one has at any given time, and we are talking about index funds here. So index funds are typically the indices that are tracked for a given country based on a typical indices. So for example, if I am if I have 100,000 today, if I have 100,000 today, and I know US in the long run going to do well, what I can do is I can go and invest in S&P 500 index fund. So when I am investing in S&P 500 index fund, basically what I am investing is I am investing top 500 US companies. So I'm going to become a shareholder of top 500. These are 500 US companies. So if you just park this money, and this money would be invested on this top 500 companies, all top 500 companies performance or the returns will become your own returns, because you are the owner of those small percentage of the uh, um, those top 500 you bought it. Does this make sense? Maybe I can show you how one can do this. So just a second. So these are the few options I can show you here. So this is I gave you the link here, Vanguard Total Marketing Index Fund. So if you just click it here. So as I was just telling, Vanguard was the first company who started index fund investing in 1960s. That's the reason whenever you talk about index fund, you can't stop talking about Vanguard, because this is the company who started the index fund. Mm. So this is Vanguard total stock market index fund. So it's investing across all the whole stock market. You can read it here. It's created in 1952. Deployed provide investors with exposure to entire US equity market. So it's investing all the companies in US. It's not S&P 500. It's total market. So it's investing all the companies. So if you want to, you don't want to, care about individual company, whether Tesla did well or Bitcoin did well, or I mean, Bitcoin is different game altogether. Let's say whether Apple did well or Google did well. You don't want to worry about how individual companies are doing. I just want to have peaceful life. Let me enjoy my own life, whatever I do. I don't want to read annual reports, and I don't want to do this financial analysis, all this complex things. I don't want to spend time on it. What you can do is you simply go and invest in index fund. There are multiple index fund options. One of the one which we are talking is, it's called total stock market index fund, uh, Vanguard's total markets index fund. With this fund, you are basically investing all the companies in US, small companies, mid-sized companies, large cap companies in US. Then the expense ratio is 0.04%. So can somebody tell me what would be the 0.04% of 100,000 if I have 100,000? But
4,000?
4,000 is 4%, right?
400?
40.
40.
40.
Yeah,
40. 40. Yeah,
exactly.
40.
So you are
40.
paying 40 crore for 100,000 Danish krone. You would be investing with these guys for 1 year. This is 1 year charge, not per month. This is 1 year charge. And yeah, so that's a very low expense ratio. So you would pay only 40 krone for these guys to invest for you in all the US companies. Um, and let's look at the returns. We are always we want to see the returns, right? We want to see how they have performed over the years. So let me see fees and performance. So We have options 1 year, 3 years, 5 years, and 10 years. So if you look at 10 years, yeah, they made 14%. And since inception, so for example, if you have invested with them since 2000, you would have made a 8.28%. But since last 10 years, it's 14%. So just doing nothing, parking money, forgetting about how individual companies are doing, how much you would have made? 14%. But look at here, how much you would have made one year? 51%. Because the last year was a crazy time, right? Due to COVID, everybody was in panic. So
Yeah.
if you would have bought 1 year ago, you would have made 51%. So 100,000 would have become 151,000. And look at 3 years, it's 18, 19%, almost 19%. So this is one option, especially as a kids. You haven't learned all the things, right? It's going to take time, and you want to enjoy with your school life and your friends and everything. I would definitely suggest you to consider index funds to start with. You talk to your parents and discuss with them and take a conscious decision. Until I learn this skill how to pick individual stocks, I would go and put it in index fund, so that I still own the market, tiny bit of market, until I figure it out how to do index fund. Sorry, how to do it in individual companies. Let's see how which are the companies this index fund is owning, right? So this is total market index fund, right? So it owns tiny bit of all the companies. So if you see, they have 3,700 stocks. Total number of stocks in this index fund is 3,007. You remember I told you they are owning all sizes of companies. It's not just a top S&P 500. They are owning small, medium, and large companies in this index fund. Okay, so they have 3,755 companies. Okay, and in that companies, which are the sectors? You remember we talked about sectors when we talked about business models. I told you, car manufacturing falls under similar business model, so we call them, manufacturing sector or car manufacturing. Similarly, these are the sectors you see here. So they have basic materials, copper, silver, all the elements you learn in chemistry classes. They are being used to make stuff, right? So that falls under basic material, you know so they invested 2.20% into basic material. So if I parked 100,000 with these guys today, 2,000 change would be invested in basic material. Does this make sense? Percentages when I'm explaining you the allocation. So I'm taking an example of 100,000. Let's imagine we invested 100,000 in this fund today. Out of this 100,000, 2,000 would be invested in basic material stocks. Okay, and 16% would be invested in consumer discretionary. These are all your soaps, toothpaste, liquids, washing, powders, all the cleanings, all the Procter and Gamble, and all these companies, Unilever products you use, Dove soap, all this. So those falls under consumer discretionary, consumer staples. So they would put almost 21% together. So your 21,000 would be invested in those companies, and then 2,000 would be invested in energy, power generation, power distribution. All these companies who are generating power, solar energy, wind energy, all this, all everything to do with energy production, transportation, is fall under 2.80%. So your 100,000, 2,000 change would go to this energy. And then financials, all the banks, Bank of America, Wells Fargo, all the big banks, Citibank in US. This is US, remember that. So all the bank financials, they would invest 11,000. 11%, so 11,000. Then healthcare, all pharma companies would go in under this. And then industrial is, railroads and all the manufacturing. Boeing is industrial, where they do the manufacturing. And then the real estate, 3%, real estate companies who are building houses, or renting out, shopping malls, all these companies, they would park 3.40%. And today, the booming is on technology, right? That's the reason in this technology takes the major part, 25%. This is where they would invest in Facebook, Google, Apple, all the big technology companies, Twitter, all the companies that you can imagine. So 100,000, 25,000 change is going for technology. And telecommunication, AT&T, Verizon, all those telecommunication companies, 2.60, and then utilities. So basically, if you invest in this index fund, total market index fund, they are investing your 100,000 into this different sectors. Within each sector, there are multiple companies, within technology, we know, Google, Facebook, all this, Apple, Amazon, all these companies. So let's look at the top holdings. The top 10 holdings of this index fund. You remember how many companies they have? They have 3,755 in this index fund. Out of those 3,755, these are the top 10 holdings. So one is Apple, second is Microsoft, Amazon, Alphabet, Facebook, Tesla, Berkshire Hathaway, JP Morgan, Johnson and Johnson, and Visa. Can anybody tell me why we see many technology companies in this top 10?
Because the 25% of their actual thing is
the most percent of it is on technology.
Exactly. Let's imagine after 10 years, when you grow up, now your average 10 to 13 years, right? Let's say imagine after 10 years, when you become 23 years, would this percentage would remain same, or would it change?
It would change.
I think it would change.
Yeah, exactly. You never know. It's only technology that would be surviving all over the time, right? Sometimes financials percentage would increase and technology probably go down to 15%. But you don't need to do anything in that case. When you are investing in index fund, it would be taken care automatically. Allocation also taken care automatically. So this is one example of index fund. So when you hear markets are panic, everybody is selling, if you don't know which companies you need to invest, one basic thing one can do is simply go and put it in index fund, because then you're betting overall market, you are not betting individual stock. And that's also reflected in the performance. So if you see here, last March was a panic. In 1 year, if you simply invested in index fund, one would have made 51% returns. Okay, so this is one index fund. There are many index funds like this. I'm giving you one index fund. In this index fund, your exposure is total market. You are investing across all market of US companies.
So do you know that it said technology is 25.5%, and then real estate is like, I mean, the financial is 11. Yeah. How do they say that? Is it how much money they make per year, or is it like the technology companies make per year, or is it like how many people? Yeah. How on what basis?
Yeah, that's a good one. That's a good question. So how do they do this is, it's based on the market cap. As we know now, technology companies market caps are crazy, right? Apple went from 500 billion to 2.2 trillion in last 2-3 years. So this allocation is done based on the market cap of the companies.
Okay.
So it's not,
And Hari,
yeah.
Hari, so
So what's a market cap?
Market cap is the price multiplied by the number of shares outstanding. So if you remember, we can market cap is the market value of the company. So if we just go back here, so if I look for Apple, so this is the market cap of Apple. So it's $2.17 trillion. This is in millions. Is millions. So you divide it by 1,000, you get it in trillions. So that's a market cap. So, market cap formula is simple. Market price. What is the share value? What is the market share? Yeah, $130 multiply with the number of shares outstanding. Then you get the market cap. So for example, if the market value of Apple share goes from 130 to, let's say, half of it. So 130 off is 65, right?
Yeah, 65.
So what would happen to market cap? It become half. So it becomes
About
one.
1.05 million ish, like something like that.
Yeah, 1 point something trillion. So that's how market cap is defined. Based on this market cap, index fund allocation also happens.
Okay. Thanks.
and Hari, so here one question. So why we are calling these as technology companies? Because telecommunications and others also energy, and these are also comes under technology, right? And
No, it's historical reasons. So after internet, whatever the companies mushroomed, since 1996, all falls under technology. Anything. I think all the companies, linked with the semiconductors, software. Uh, this is since 1968 when the Intel went to IPO. So they started this technology, and then Microsoft, Apple came to IPO in 1978. Since then, it just continued. So I think this is historical reasons. If you go back to 1930s, you did not had a technology. It was only basic materials, consumer durables, and energy and financials and healthcare. Once they realized, IBM was the only company, in founded in 1930s, HP 1930s time frame. Then all of a sudden they become so big, then they have to make a different category for them. That's how they do this split. It's like anything, right? If you have so many things, if you open your closet, you would see quite different kind of clothes. Then you categorize, oh, this is sportswear, this is formal, this is party wear, this is, it's the same here in with respect to companies. When they become so big, they try to categorize them into one bucket so that they have a, there is no strict logic behind it. It's basically for countries
okay.
to, yeah, exactly, to I may wear formals, t-shirt and jeans for office. Should I call it as a office wear? No, right? So there is no
Mhm.
logic. It's just understanding the market in simple term.
Mhm. Got it. Got it. Okay. Yeah. Thank you.
So if you see Johnson and Johnson, it falls under consumer durables, soaps, Johnson and Johnson soaps. JP Morgan and Visa, they falls under financials. So that's where you have this financial allocation. And Berkshire Hathaway falls under industrial. So you have this industrial, right? Yeah, it falls under industrial. So this is index fund, one index fund example, and maybe you are interested in Nasdaq. Then you could only invest only in stock companies. So Vanguard also have a Nasdaq index fund, so people can also invest in Nasdaq. So when you invest in Nasdaq index fund, oh, this is also total market. Okay. If it is Nasdaq, then people are investing only technology companies. That's also a difference. So let me show you one more index fund here. So you see the difference between two index funds, which I showed you. So first one was, let me open the other one also. So I'm opening both links. One is, this is a Vanguard Total Stock Market Index Fund, VTSAX. The second one which I opened is VTIIX. This is Total International Stock Market. So if you are a person, you don't want to rely only US companies, you want to rely across the world, all the big companies in the world. I want to have them in my bucket and I want to invest in all those companies. So this is the index fund where you can invest. This index fund basically Vanguard Total International Stock Market. So let's look at how they did allocation. So first thing you need to look at is the expense ratio. You see here, it's a 0.11%. The difference, before you have to pay only 0.04%. So here you have to pay only 40 kron for 100,000. Here you would pay around 100 kron, right? So that's a difference. You need to first look for the expense ratio, how much they are charging. Okay. Second thing is look at for the, yeah, you see the allocation now, because this is all the kind of all the markets across the world. You are basically owning all the companies, big companies in across the world. So they have allocation, 25% allocation to emerging markets. Emerging markets are like India, South Korea, so and so. Those are emerging market. And 38% is Europe, and 28% is okay, 6%. I don't know what is this Asia specific? Yeah, maybe. Yeah, this is Asia specific, and then Middle East. This is North America, and then others. And you see the allocation changed drastically now. Top 10 holdings now. This is chip manufacturing company from South Korea. Sorry, not South Korea, Taiwan. TSMC, that's a big company. Tencent is from China. Alibaba also from China. Samsung, where is Samsung from? Does anybody know where is Samsung company is from?
Japan, right?
Japan or North Korea? I don't know. Japan or
It's
South
Japan.
Korea?
I
It's
think
probably
not-
Japan.
No, it's a South Korea. It's a South
Oh.
Korea based company. Yeah, Japanese companies world has gone. They were great in from 1970 to 80s. Now it's predominantly dominated by South Korean companies.
South Korea.
LG is also South Korea. Samsung is South Korea. Panasonic is still Japan, I think. But the majority of electronic companies are pushed to South Korea. And Nestle is from where?
Switzerland.
From
Exactly.
US. Oh, okay.
Switzerland, yeah. It's our neighbor, Denmark neighbor, right? So the reason I'm showing you is this is, you are all of a sudden holding companies across the world by investing in this index fund, right? It's a total international stock index fund. And LVMH is from France. This is a France-based company. Novartis, I don't know. I guess it's from Germany. Toyota from Japan. so and so. So basically you are holding companies across the world. So let's look at the returns. 1 year, one would have made 41%, but the returns are not that great. If you see 10 years, they made 4.97%. Since inception, it's 6.28%. But here, if you look at this total stock market index fund, since its inception, they made 8.28%. 10 years, they made 14%. Whereas this one, 10 years, they made only 4.97%. Why do you think this index fund did not performed well comparing to this other one?
I think because it might be because it's from all other countries and not only from one country.
Yeah, exactly. That's a good thinking. Yes. So it's across the world, right? So all of a sudden, if my Chinese companies or South Korean companies, due to many reasons, right? Every country go through different issues. If they did not performed well, all of a sudden the fund would also not perform well because it's allocating all the company country companies. So uh, diversification. See, basically, when we are investing in index fund, what we are doing, we are moving from single stock pick to diversified portfolio. Diversified portfolio means you are investing in bunch of companies. So when you are investing in US total market stock investing, you are already diversified enough. You are already investing in 3,700 companies, right? I think you saw this here. So 3,755 companies. I'm already diversified enough. If one of the company blows out of this 3,755, I would not be impacted. I have enough diversification. I'm splitting my money to all this 3,755. But if you do international companies, how many companies it's invested? 7,000 change. 7,550 companies. That's too much diversification. So one has to balance, should I diverse too much or should I diverse enough? That can be good enough. So these are the two funds. If you want to have exposure to US or if you want to exposure to across the world, this is and in India you have similar thing. It's called Nifty 50. So basically top 50 companies of Indian market, one can invest here. So these are the companies. So I opened this. Uh, I opened India Index Fund. This is Nifty 50. That's if one wants to have exposure to Indian companies, you don't have time to investigate all the companies, analyze all the companies. What what you can do is you can go and invest in Nifty 50. So basically Nifty 50 is top 50 companies of NSE, National Stock Exchange, and these are all the top 50 companies. As you can see here, you have Asian Paints, Axis Bank, Bajaj Auto, Bajaj
So
Finance.
wait, so I have a question. So these 50 companies, are these Indian or is it like Asian wide or worldwide?
Yeah, yeah. This is India Index Fund. So this is
Okay.
India. It's
Okay.
only top 50 companies of India. So you see here Airtel, Bajaj Finance, it's finance. This is pharma companies, Davies Labs and Dr. Reddy's. Acer Motors, we saw this one, two-wheeler manufacturing companies, and HDFC Bank, so and so. These are top 50 companies of US. Uh,
Uncle, is
yeah,
there also Reliance?
yeah, it's here, Reliance Industries. Yeah.
Okay.
So if you say that I have a pocket money of 10,000 Danish krone, I don't know where to park, but I'm betting in India. I think India would emerge as a big economy in the future. You simply go and invest in Nifty 50. Basically, you are buying top 550 companies of India, and you are betting India would do good in the long run. Same with US market. When you are investing in this index fund, what you are doing is you are betting on US markets, and you think US companies would do in the long run. And we have similar for Denmark. I would find the Denmark index funds. You could also do the same for Denmark companies. Yeah, Ayush, you have a question? Yeah.
Yeah, uncle. So how did Nifty 50 perform last year?
Yeah, let's look at it. Yeah.
You yourself look at.
Yeah, so this is their expense ratio. You remember, this is also something you need to watch out. There are two options in this expense ratio. One is regular and another one is direct. I need to explain this so you understand. Regular means somebody who has savings every month. It's called systematic investment plans. Every month after all the expenses, they would like to invest, whatever 10,000 krone or 5,000 krone savings they have. They want to invest every month. That's called regular. Direct is somebody, have 100,000 cash sitting from last 10 months savings. They do one time direct. So when you do direct, your expense ratio is low. When you do regular, your expense ratio is bit high. Do you see the difference? In US market, you have to pay only 0.04%. Here in Indian market, you are paying 0.40%. So can anybody tell me what would be 0.40% of 100,000?
That was my question, uncle.
400 kroner.
Yeah,
400.
exactly. It would be 400 kron. So you would be paying 400 kron for this fund to invest it in top 50 companies in US, sorry, in India, whereas in US you would be paying 40 kron. You may ask why it is so expensive in India comparing to US. The reason is the volume. In India, the number of people who are investing in index fund is low comparing to US, because you remember in US it was started in 1960. It became well known uh, across in US, and many people are investing in US, in US index fund. So when you have large volume, the price of managing the index fund goes down. Whereas in India, the volume is so low. You see here, it's only 2,928 crores invested in this index fund across India. Only 2,928 crore. And US, sorry, Indian overall market economic market value is 2 trillion. Out of 2 trillion, only 2,900 is been invested in this index fund. So that's how low people are. I think in India, many people are going after individual stocks, and they think they can do better than index fund. That's the reason. But in US, there are many people, they feel that their index fund is better for them because they don't have time to analyze and do the investing. So if you invest a lump sum amount, it would be only 200 kron that you have to that you would be charged.
But uncle, how did it still perform last year?
Yeah, I'm searching for that. Just a second. I don't
Okay.
see. Mm, let me do search here. Any questions? Does this make sense, or is it too difficult to understand?
It's a bit complicated.
Okay.
Makes sense.
I think it's a bit complicated.
Okay.
Uncle,
Yeah.
is there any limit of money you can put inside the index fund?
No.
Okay.
You could invest as much as you want. I know few people who became millionaires just investing in index funds, but they are doing it for decades, 20 years. So that's also advantage for your age. If you start from now, by the time you become 25 years, you would be wealthy enough. So, okay. So for HDFC index fund, the last year return was 62%. And last 3 years, 12%. Last 5 years, it's 14.9%. Since inception, since they started, I think the fund was started on 31st December 2012. Fund started, yeah. Since its inception, it's 12.9%. So if you go and put a fixed deposit in Indian bank, you get around 3 to 4% interest in India. If you would have parked your money in this index fund, you would have made almost 13% since 2012. In last 1 year, it was 62%.
Uncle,
Yep.
if if this one costs like 400 kroner and the US index fund costs, like less, then everybody would choose to, invest in the US index funds, right?
Yeah, that's correct. But people in India, they don't have option to invest in US markets. People in Denmark, it's easy for you to invest, but people in India, it's not a.
Oh, okay.
Yeah, suppose if I'm earning in Indian rupees and I have to invest in US dollars, exchange when I convert Indian rupees to US, exchange rate eats up my 0.2, 0.5, sometimes 1% of money.
Yeah.
So that's the reason many of my network friends whom I know in India, they don't prefer investing in US. They say that, hey, when I exchange from INR to USD, I'm already losing some money. On top of it, it's they think it's a big amount. So and until recently, there was no option a guy in India to invest in US market. But since last 3 years, now we can invest in US market. There are many brokerages who opened. But you are right. If you are in Denmark, if you have an option to invest in US versus India versus Denmark, you could easily do all three if you want.
Yeah.
But a person in India, it's a different situation. Yeah.
Yeah, but then, Uncle, how can you invest in a US index fund when you're in when you're in a different country?
Yeah, there are different brokers. For example, this broker, Interactive Brokers, they are in India as well as in Europe as well as in US. So if you open account in this brokerage, then you can invest in India or Europe or in also in US. So there are some platforms through which we can invest across the world. So
Okay,
one of
thanks.
yeah.
Yeah.
Okay, if you feel complex, maybe we should continue next week just to see, or we could invest ourselves in this group, one index fund, and track it when we are doing sessions every week to feel
Yeah.
how.
Yeah, I think so.
So which one would you vote for? Which one should I pick? Should I pick in Nifty 50 or total index fund?
I don't know. Maybe can we do both? Like put a bit in
Nifty 50 because it has the most percentage.
Or you mean returns are good?
Yeah.
Yeah.
Okay, how much you want to invest, and then I can create a virtual portfolio. Then we can track every week when we start the session. From today, I would put 100,000 This is a not real money. This is just a money we are putting, and then we track it. After
Oh, it's fake
6.
money just to see.
Yeah, exactly. But if you once after couple of months, once we matured enough, we could also do real money. I can put a real money if you guys want to invest some money. We could also do that. But
Yeah.
Yeah, that's gonna be
If
really
it goes
cool.
good, right? But that's if it goes good.
Yeah, if it goes good.
I have a question. Let's say it doesn't go
Yeah.
good in Nifty 50. Then can we try the U.S. index fund? And then if it goes good, yeah.
yeah, the index funds are
But
for
isn't
long.
it just that you'll basically lose 1,000 or something like that?
I think any investing you should look for long term. You should not track.
No, but you can't just for investing. You have to set a border, and then you have to do until the border. You can't just think that we pay, and then if it goes good, then we keep doing it, and if it goes bad, then we just change the investment. You have to you have to
Because
look
it's
at
in a long term. So
Yeah,
yeah.
it's
even if it goes
You can't
bad
just buy it
now,
and then yeah, and plus we lose money if we just buy it, and then if it goes down, we just sell it, and then we do another one. You can't just think if you have to set some borders.
No, it's because if it goes bad now, it doesn't mean it will go bad in the future. You
I know, but
leave.
it could go bad.
Yeah,
yeah.
could go
But
bad.
it's also
why
like
that
that. It's also like that with stocks. So
True.
exactly.
I
It's
mean,
like a Virat Kohli,
you
right?
can't just invest.
Yeah.
You can't just invest if it keeps going up for 10 years. That doesn't mean that you can just invest, but you still have to know what's going to come in the future.
even
Like
for index
Corona,
funds, it's also kind of like luck.
That's what
It's not
everyone
just it'll
thinks
go
of.
good.
That's what everyone's talking about long term. You should look in the long
Yeah.
term. Not
You
if
can't
it's
just think that if you
now.
buy stocks and then if it goes bad, you just sell it, and if it goes good, you keep doing it.
I know. Yeah.
Like
exactly.
some good investors, they must have known that something was coming in 2020 or 2019 December. So then they know that the stock market's going to go up, like because of Corona. Like video game companies went up a lot because people were home and then they played a lot of video games.
Because they had
So
nothing
they
to
have
do.
they have to know that something's coming, like that. People have to know what's coming to buy stock.
Yeah, but we
It's
don't.
not.
To know, nobody knows what happens tomorrow. So
I know, but
it's just assumption that great investors knew something is coming, but it's not true. Even when they were
I know, but
investing, yeah,
those assumptions came true if they had to like study a bit about it.
yeah.
So what's the
It's
argument?
not so easy. It's not really guesswork.
Okay, so if you all agree, I would park in the index fund, this HDFC index fund, and as well as Vanguard total market VTSAX 100,000 each, and we will
Okay.
track that.
Yeah.
Yep, I'm fine with that.
Yeah, and we
Yeah.
will track it in the Excel sheet. We have this Excel sheet, right? We will track it, and then you would understand the emotions part when it goes up and down. How do you feel?
Sure.
I have a question.
Yeah.
So, like you said, you're not going to put real money in. How's that possible?
Yeah, there are some portals, or you can simply in Google Sheet, you can track the portfolio. So if you go to Google Sheet, you can track you have Google Finance, right? So you have some functions you can call on Google Sheet, and then you can track the performance. So I will show you how to do that. It's possible.
Okay.
But the problem with the virtual money is you don't get the real feeling. So what I would do is after a couple of months, I would ask you to invest your savings. Then you will understand the emotions behind it. Because if it is fake currency, you don't feel the real emotion behind it if it goes down and up. If you put your real money, then you will feel the emotions. That's That's something you need to learn over the years. Okay. Get as much as your savings. Then we will probably in 1-2 months we will start a real investing.
Okay.
Bye. Thank
Bye.
you.
Thank
Okay,
you.
thank
Bye.
you.
Thank you.
Bye.
See you next week.
See you next week. Bye. Bye.
సూపర్ అన్న బాగుంది హరి